Consider the following summarized balance sheets of subsidiary B Limited. For 2 years, 2015 and 2016, they are given as the balance sheets. Share capital is given, reserves and surplus, current liabilities and provisions, bank overdraft and the provision for taxation. So pretty regular balance sheet is given. Fixed assets, they are saying cost less accumulated depreciation. Investment, in that they are saying non-current assets, then inventory, trade receivables, prepaid expenses and cash at bank. They say also consider the following information. Okay, in A they are saying that B Limited is a subsidiary of A Limited. Okay, both the companies follow calendar year as the accounting year. A Limited values inventory on weighted average basis while B is using FIFO basis. To bring B Limited's values in line with those of A Limited, its value of inventory is required to be reduced by 12,000 at the end of 2015 and 34,000 at the end of 2016. So parent and the subsidiary are not following the same accounting policy. Parent is following weighted average method for valuing inventory, while the subsidiary is following the FIFO method. We know that ideally the parent and the subsidiary should be following the same set of accounting policies. But in case that is not so, we should ask the subsidiary to redraft its financial statements and confirm with the accounting policies of the parent. So we will ask the subsidiary B Limited to follow the accounting policies of A Limited. If B Limited follows the accounting policies of A Limited, it will have to reduce its inventory. Opening inventory will reduce by 12,000 and the closing inventory will reduce by 34,000. That's what they say. Similarly, they are saying that B Limited deducts 1% from the trade receivables as a general provision against doubtful debts. No such information is given for the parent. That means the parent does not follow such accounting policy. So we will have to ask B Limited to reverse this provision. And finally, in D, they are saying prepaid expenses in B Limited include advertising expenditure carried forward of 60,000 in 2015, 30,000 in 2016, being part of initial advertising expenditure of 90,000 in 2015, which has been written off over the period of 3 years. So you are following the policy of deferred revenue expenditure. Total expenditure incurred by you was 90,000. 90,000 divided by 3. Every year you are debiting your P&L by 30,000 rupees. Then they say similar amount of advertising expenditure of A Limited is fully written off. So A Limited does not follow the policy of deferring expenditures. If A Limited incurs advertising expenditure, entirely it will be debited to the P&L. So we will ask the subsidiary also to debit it to the P&L. Right? They say now, restate the balance sheet of B Limited as on 31st December 2016 after considering the above information for the purpose of consolidation. Would restatement be necessary to make the accounting policies adopted by A Limited and B Limited uniform? Yes, it is necessary. Ideal situation under accounting standard 21 is that parent and subsidiary follow uniform set of accounting policies. But by chance, if it is not so, at least for the purpose of consolidation, we shall ask the subsidiary that confirm with the accounting policies of the parent. So we will restate, we will redraft the financial statements of the subsidiary and confirm that with the accounting policies of the parent. Once that balance sheet is ready, then we will carry out the consolidation with the parent company. So in this question, consolidated balance sheet is not required. You have to simply prepare a restated balance sheet of B Limited. Restated, B Limited as a subsidiary should conform with the accounting policies of the parent. So we will have to simply give effect of the adjustments B, C and D. And we will have to find out that what will be its impact. B, C and D will affect different assets. See, in B they have given you an item of inventory. Then in part C they have given an item of trade receivables. And in D they have given prepaid expenses. All the three items are lying on the asset side. So accordingly the assets will get affected and the corresponding effect will be given in the reserves. Right? If any additional expenditure is to be debited, then obviously my P&L will reduce. If any expenditure provided is reversed, then obviously my P&L will increase. So depending upon the information which they have given, we will have to give a fact in our results. If we see the balance sheet as on 31st December 2016, in the balance sheet of 31st December 16, your reserves and surplus right now is 7,14,000. So we will start with 7,14,000 and give a fact of the adjustments. After all, the restated balance sheet is to be prepared on 31st December 2016. So let's work it out. Say determination of reserves of B Limited on 31st December 2016 after realignment of accounting policies with those of the parent. Right, we are working out the reserves after the realignment of accounting policies with that of the parent. Say reserves as given, 7,14,000. Then we say adjustment for. Yeah, the first one is for the inventory. See, in 2015, inventory will reduce by 12,000. And in 2016, inventory will reduce by 34,000. We are calculating the reserves on 31st December 2016. So it is this 34,000 that should be considered by us. So we say reduction in inventories on 31st December 2016. If your closing inventory is reducing, your profit will reduce by 34,000. So I'm keeping that as negative. Of course, you may argue, what about this 12,000? Why are we not giving effect of that? Because closing inventory is reducing, then my profit will reduce. Opening inventory is reducing, then my profit should increase, isn't it? But why am I not giving effect of that 12,000? See, when you are calculating the closing inventory, for the purpose of calculation of closing inventory, you will have to also update the opening inventory. See, without updating the opening inventory, I cannot update my closing inventory straight away. Try to visualize a stock sheet. In a stock sheet, I will start with the opening inventory, then there will be purchases during the year, and then I will find out the closing inventory. So when you are calculating closing inventory includes the impact of the change in the opening inventory. In other words, this 34,000 is capturing the effect of 12,000. So please do not give separate effect of 12,000. Closing inventory cannot be updated without updating the opening inventory. So closing inventory effect already includes the opening inventory as well, right? So don't consider this 12. Okay. Now we consider the next one. B Limited deducts 1% from trade receivables as a general provision against doubtful debts. Nothing is given for the parent. Indirectly, they are saying that parent does not follow this accounting policy. Fine. So if B is following this accounting policy, we will ask the subsidiary to reverse the effect that it has given. Okay. 1% from trade receivables. Let me return back to the balance sheet now. Let me see what is the figure of the trade receivables. They are saying that the trade receivables are 8,91,000. If the trade receivables are 100, I am providing 1% of the provision. That means it will be 99. Okay. So 8,91,000 should be divided by 99%. I get 9 lakhs. From 9 lakhs, I will deduct 8,91,000. Or I can say 9 lakhs into 1%. So 9,000 rupees of provision is there. This provision should be reversed. You must have debited this provision to the P&L. When you will reverse it, your profit will increase. So we say here, general provision on debtors reversed, right? We say 8,91,000 divided by 99%, right? That's what I did. That is 9 lakhs into 1%, 9,000. And now in C, they are saying prepaid expenses and B Limited include advertising expenditure carried forward 60,000 in 2015, 30,000 in 2016, and it is an initial expenditure of 90,000 in 2015. So 2015 is there and 2016 is there. 90,000 is the expenditure incurred, and then we say less debit P&L. So we are what I can say, we are amortizing this over a period of 3 years. So in 2015, I debit the P&L by 30,000. So I get 60,000. 60,000 I am reporting in the balance sheet. That's what they say here. 60,000 in the balance sheet of 2015. So now in 2016, it will be 60,000 and I debit another 30,000. So in the balance sheet, you now have 30,000. So they are saying that 30,000 is there in 2016. If the parent had incurred such an expenditure, it would have been debited to the P&L straight away. So just ask yourself, how much is still pending to be debited to the P&L? Right, this 30,000 is still pending to be debited to the P&L. See, this 30,000 is already debited to the P&L. This 30,000 is also debited to the P&L. But remaining 30,000 is still there. So this 30,000 we will debit to the profit and loss account. So we say unamortized advertisement expense charged to revenue, right? We charge it to revenue. Another 30,000. So 7,14,000 minus 34 plus 9 minus 13. I get 6,59,000. This is our restated results on 31st December 2016. So when we prepare the redrafted balance sheet, we will be now showing the reserves at 6,59,000. Let's prepare the restated balance sheet. So we say restated balance sheet of B Limited as on 31st December 2016. Show under that A, share capital. There will be no change in the share capital. So 5 lakhs as it is. Reserves and surplus. We calculated 6,59,000. Then there are current liabilities and provisions. Non-current liabilities, there aren't any. Current liabilities, none of the current liability figure is getting affected, so I'll just copy it down. Trade payables 4,94,000. Bank overdraft, we will say short-term borrowings 1,70,000, right, the way it is. And provision for taxation, we say short-term provisions 4,30,000, right. Six lakhs 59, 494, 170, 4,30,000. Are getting 22,53,000. Yeah, the main head, you can put that it is equity and liabilities. Yes. It's time now to consider the assets. You will continue below that only, but for simplicity, I'm just moving on to this side. So here I'll say 1, non-current assets. Right. So that we say A, property, plant, and equipment. That's where I will show my fixed assets. There's no change there, so I show it as it is. 2,24,000. Say non-current investments 4 lakhs as it is. Two, current assets. Under that we say A, Inventories 7,42,000. So I say 7,42,000. We have reduced the inventory by how much? 34. And we say B, trade receivables. They are showing in the balance sheet 8,91,000. We have increased the debtors by 9,000. Then prepaid expenses. We'll show that a bit later. We say cash and cash equivalents. There is no adjustment here. 3,000. Then we say other current assets, prepaid expenses 48,000, which we have reduced by 30,000. Okay. Great. So let's put these figures now. 7,42,000 minus 34, 7,08,000. This is 9 lakhs. This is 18,000. Time to take the total. So 2,24,000, 4 lakhs, 7,08,000, 9 lakhs, 3,000, and 18,000. Which was it here? 2253. Yes, that's what I get. 22,53,000 total. That's your balance sheet.